Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately it's approximately 8:08 p.m. on 5th of December 2018. This is a strategic weekly midweek update webinar, which we are going to quickly take a look at some of the shenanigans that's happening out there, some extreme volatility, some extreme market moves. Try to make head or tail of what exactly is going on, looking at the charts, and we shall begin. The session will be recorded and uploaded to the Clueless Trading YouTube channel for viewing by all members and anyone out there with the internet connection, so they can gain some valuable insights into the dynamics of the U.S. financial markets. Full disclosure, this is purely for financial education, not for any solicitation or advice. On that note, thank you for attending. I know it's midweek. It almost feels like a weekend, so people's bio clocks are a little bit off. Mine is. Anyone who's coming in can certainly, sign into, and of course, they can hear it later. Bear with me one quick second. Okay, I'm back. So just to recap, since our last webinar, strategic webinar videocast, we had a pretty phenomenal rally, and then the markets, just all the technicals look fantastic. President Trump created quite a positive buzz around the markets with his constructive meeting with the Chinese leaders at the G20 meeting. There was a great positive feeling that finally some of the risks that we talked about regarding the trade deal, China-U.S. trade wars, and of course Fed Chairman Powell's speech, which caused a massive rally on the 28th of November, just a couple of days ago. Last week was all kind of behind us, and we could move forward towards having a little bit of a less volatile and a little bit more of a predictive market. Well, looks like things didn't go that way, at least for now. However, the downside that I was talking about, and this is what's important about strategic tactical forecasts, because we're living and breathing and surviving through charts. But the downside that I was talking about, the pullback scenario, is exactly what is taking place as we speak. So what I'm going to attempt to do tonight very quickly is try to show what the possible downside levels are, so we are prepared where we can enter some positions and catch those vicious rallies that generally occur within 24 to 72 hours of 1,000 or 800 point drop in the market. In this particular case, we're down a little bit more than 1,000 points, by the way, because futures right now are down 24. S&P futures. So net, we are down roughly 1,000 points. Just the way we are, by the way. The night of the elections, when they said the world was going to go to Armageddon, night of the November elections, when President Trump was elected, futures were down 100 points, and at one point we were down 700 on the Dow, and then they stopped the futures. But we were net down, 1,000 points. Just the way we're down about 1,000 points since Tuesday. Wednesday being a holiday today for the funeral of President Bush. God bless his soul. So bottom line is that let's look at the charts. Let's be prepared. We do not control the markets. This is unprecedented volatility. Nothing that we can structure and measure. So I want you guys to be in the same boat as I am. It is not fun. No question about it. It is irritating. It is frustrating. And in the midst of all that, Clueless Day Trading, Frank is here on a Wednesday evening, walking you guys through some of the things that I can see, some of the things you guys should all be prepared for. We are not in the business of emotionally panicking or emotionally getting overexcited when I told people to sell the huge gap open after the China deal was signed. Right there at around the 2,800 plus level. That was fantastic. I did not push people to go out there and bet their, I did some selective trades, of course, but I did not, I kept on saying it. I did not tell people to go out there and just go hog wild buying things. However, what happened on Monday? No, this was Monday. Losing track of time here. What date was Monday? Monday was the 3rd. Yes. So what happened on Tuesday? This huge candle was a combination of 3 different things. They said Trump tweets and the messages coming out of China that they were not pleased with President Trump bragging or boasting about the China deal. That's all garbage. China reiterated that they're going to go ahead and implement the reforms and the other stuff they're talking about in a much faster pace. Look at one of the articles that I put out there, posted over the yesterday. China again reiterated. I'm looking on Bloomberg, and I follow the South China Morning Post to look at some of the breaking news that's coming out of it. They're okay with what's going on, meaning to move on forward. They are not being hostile. They're being deferential. They're being respectful to President Trump and the demands of the United States on certain improvements that need to be made. They're opening up their agricultural imports, increasing that. They're looking to reduce tariffs on cars, all kinds of stuff. So that's not the issue. The issue isn't any type of massive fallout because there are rumors again that Apple is not selling phones and all that stuff, and some big shot analyst is out there downgrading Apple. The issue has to do with a technical, what should I say, massive mismatch. I'm looking for a word here, technical glitch or whatever you want to call it on the bond side. And I don't want to get into it too much because after this session, I'm going to post an article that I want all of you to read. It is called Inverting the Yield Curve. This is kind of high-level credit mumbo-jumbo, but it's explained pretty nicely on that Bloomberg article. When longer-term yields, let's say the 10-year bond goes below the short-term yields. Because generally, the longer-term bonds should be at a higher interest rate or yield than a short-term, let's say, 2-year bond. So it's called the 210 inversion curve or the 510 inversion curve, which basically the curve inverted. Now that causes massive disruption in the large credit funds, which are forced to sell because as the yields are falling, they might have had a long position on that, and all of a sudden the yields are falling. The 10-year yield has dropped from about 3% down to about 2.9%. Percentage-wise, that's quite a drop over the last couple of days. So this yield inversion, and please read that article, because it explains very clearly why in some cases it might show that the U.S. economy is going to go into a recession in 2019, which is hard for us to believe given that we have such positive headwinds which are pushing us, the U.S. economy overall. The consumer is still strong. U.S. companies are doing well. The China issue is being resolved to a large degree. So you'd wonder, why should we go into a recession? Well, one of the reasons could be that the Federal Reserve, and I don't think it's going to happen, but the Federal Reserve, despite what they're saying, will keep on raising rates and put the brakes on the U.S. economy, which will push us into a recession. Remember, we have a rate hike coming this week. Not this week, next week, I believe, at the Federal Reserve meeting. That's a given. We already know that. But he's already mentioned that he's not looking to really press the pedal to the metal. And other Fed governors have said that too, on raising rates too fast, too quickly, going into 2019. So what's the massive imminent DEFCON 5 danger? that is causing the bond market to invert the curve and cause this massive disruption in the overall stock markets. Remember, the credit market is a very large, multi-trillion dollar market, bigger than the stock market. Most people don't realize that. So that's really the issue that happened. It was a thin day, meaning liquidity was light. I'm talking about Tuesday. And the quant funds, and I'll post that article too, which I just read on Bloomberg. The quant fund, the quantitative algo HFT driven funds, they went nuts. Selling begets selling. Momentum, right? So the key is that that's really the main factor was driving the market. It is dislocation and forced institutional margin selling on the credit bond portfolios, very large ones, completely getting hammered because of this suddenly falling yields across the board and the inversion, yield curve inversion, where the shorter term rates are higher than the longer term rates, or almost getting there, causing a massive fear that we have imminent recession at our doorstep, which is unlikely, to be honest with you. But what do I know? So the markets are behaving very panicky. I saw readings on Friday, not Friday, keep on saying Friday, on Tuesday, which were horrendous, out of control. I mean, extreme readings, strain above 2.4, all kinds of stuff. The advanced decline line just collapsing. And this is all after we have a massive rally. You can see that. This is the picture of the markets. Let me zoom in. Since this is November. This is October, actually. So here was the big rally, right? The China deal right there. We gap open. This is the close, the Friday. This is where we gap open. Choose the print color. Remember, visuals, a picture speaks 1,000 words. That old saying, right? So it's much better to explain it this way than sit there and listen to me just explaining some nerdy stuff to you guys. So bottom line is, this is what we were. We closed here Friday, and overall phenomenal, I think 1,500 plus point rally from 2624 to 200 times 8. Yeah, like about a 1,500 point Dow rally. And then I explained everything, what would happen. That was happening. We did a short, which worked out very well. Actually, I did not post that short. I'll be honest with you, because I saw the level break. I reacted very quickly. I did not know how fast this thing would work. I did not post it. I did post it in the chat room. So if you're in the chat room, you saw me saying, hey, got into the spies on the break of the 275s. We bought the 276 puts, which went berserk. I have that here on my screen. Those were the 276 puts. Now, keep in mind, and this is a very important reminder, I spend a lot of time and energy posting these real-time charts. You do not need to always wait for my call. You see a level breakdown, jump in, buy the puts. They were around 40, 50, 60, 70 cents. They actually went to about $5 on this 800-point drop, which was unprecedented. The market just boom. But it's fast, they're furious, they're very quick. And honestly, sometimes I won't be, especially in a thin market, I won't be able to go ahead and post that. So you'll have to follow the charts. And if you have time, if you, let's say that day, you're looking at, you have to have the charts in your hand. Okay? On whatever gadget you're looking at. You could say, okay, level broke. He showed that this was the level. It broke. Let me take a couple of those puts, and bang, you make it. It's a home run. Now, in between all this, there are selective stocks that fantastic trade. I have to remind people, still ongoing. Like Toll Brothers, they were 10, 15 cents. They went to $1. They went to $1.20. These are the 33.5 calls for next week. They went to $1.25. Guys, that's 1,150% in profits. So even if you bought it at 30 cents and they went to $1, you got to triple on your money. All right? So in between all this yield curve inversion and blah, 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 all kinds of stuff, you can do these selective trades that I'm putting out there and make a killing. So you got to think outside the box, because this market really, from a volatility standpoint, is absolutely nuts intraday. Stuff's happening so fast. I mean, I'm always used to speed, but things are happening so fast, so quick, Levels are being breached that I thought would take maybe a couple of days. But the quant funds, which are multi-billion-dollar movements, when they are selling or when they are buying, okay, when they're buying, you get this type of forced move. The Powell rally right there. Right there. Chairman Powell. Then you came back and retested that. So I figured that the retest would be, where we would bounce again. It did. It started to bounce over that. It fell. It closed here on Monday. Then today, markets were closed, but overnight yesterday, futures were up about 16 right there. This is what we're seeing right now in action. Futures are down 35, just going whoosh down. Is this a repercussion of what happened on Friday? I stopped saying Friday. I'm telling my brain. Monday? Possibly. There is one other event that is right now is happening. And I'm keeping you guys completely in line here, okay? So you're prepared. Is Huawei, that's the largest cell phone company like the Apple of China, Huawei, the CEO of Huawei, who was wanted by the U.S. authorities for violating sanctions against Iran. In other words, Huawei did business with Iran against U.S. laws, which prohibits any company doing business with the U.S. Cannot do business with Iran. The sanctions, Iranian sanctions, all legal stuff. The Huawei CEO, this lady, was arrested in Vancouver, Canada. So the fear is that it's like arresting Tim Cook on a charge that the Chinese have against him. The fear is that this will cause the Chinese to harden their stance on the trade stuff. I don't think so. I think they're going to negotiate it out. Whatever the charges are against her, she'll be allowed to return back to China. Remember, she's a businesswoman. She violated U.S. laws, that's for sure, from what it looks like. I don't follow Huawei. It's spelled with Huawei. So it's pronounced Huawei, yes. So they're saying, okay, this might be another fly in the ointment. Whichever the case, the real reason why this is happening right now, and let me zoom in, where futures are down 34 points, and it looks like it wants to come in we already retested 2650 at 6 p.m. when futures open. Right now we are here. So it looks like, and this was where the second leg of the rally started at 8 a.m. on the 27th of November. That was last Tuesday. Things are moving fast and furious. You get in there, you get the rewards, you get out of Dodge, but it's never that easy. It's never that easy. So I want to impress that. You want to make some good money. You want to get those trades that deliver the 300, 400, 500%. Remember, on this move up, after the China deal, there were certain options which were up 600, 700%. So if you weren't positioned here, this is what I keep on talking about all the time. Whether one likes it or not, that's the only way to go. The positioning was here, and of course on the double bottom, very powerful double bottom. The rewards were gained here. Chasing the market here, which could certainly have done this if the bond situation and the technical fallout on the yield curve inversion didn't take place, we would be at 28.25 right now. But because this happened, obviously, after this level broke right there, and I've been showing this for a while now. Look at this. There's a red line here, guys. You cross the red line, you are going to fall. These charts are not a joke. Like I was saying, I spend a lot of time and energy, real time, and after the market, adjusting my chart so you guys can know when to take out, or at least leave small positions and take out the bunch of the stuff. So the sell was here. All good. And then this happened. So you could have easily shorted. You could have done that. And this is where we are right now. This is a climactic sell-off that we are seeing over a matter of 48 hours. So there will be a climactic short-term bounce, in my opinion. It always happens. Always happens. I don't need to prove to you guys. Because I don't need to prove to anybody anything. Look at this. This is since not eternity. This is in October. This is October 3rd. This is the face of volatility. We've already gone through this in multiple charts, and in between more volatility. So it's not the first time. And we can move out, and you can see we can transplant that same and then we can look at since November 7th, and this is where we are right now. So let's focus on where we are right now and see where we can go. So this level here is very critical. We are losing more than 1,000 plus points in the Dow net since Tuesday. Remember what happens. You lose 1,000, 1,200 points. You inevitably, 90% of the time, get a massive reflex bounce. That's what we want to catch. That's what we want to sell. If somebody asks me, what do you think the exact bounce is going to be? Well, I don't know. But I can see from the charts that one level is 2650. Remember, these are the E-minis, active dynamic charts. And 2625. Both. This was the breakout zone. That's where we are right now, retesting that. This was only from the 27th, from last week. So this is it. In effect, if you look at the charts, it's really that simple. If you hold your nose and we get to these levels, we get that whoosh down to 2625, you want to be a buyer because there is going to be inevitable bounce. You don't fall 2,000 points. We have not fallen 2,000 points in 2 days. You fall 1,500 points, you'll get a 300-400 point move higher. They'll sell that or they'll run it. Most probably they'll sell that because that's the first dead cat bounce or reflex bounce. So playing a little bit of the SPY calls, why not? Now, I warn people straight out. I seldom, I never get scared of the market. Do I feel crappy about it sometimes? About my P&L and stuff? Absolutely. Do I panic? Never. That's not in my genes. I don't panic. I don't get scared. Bring it on. I'll fight it. I'll try to win it. If I think it's too much to win, I'll back off. Sit there. Come back. I'll win it. That's how we do it at Plutocrate Trading. I'm dead serious. We don't panic. We stay engaged in battle. Because if you leave the battlefield, you're no longer a trader. You no longer will make any money, which 99.9% of traders did not on these massive moves up higher. Massive, massive. These are monumental, these type of moves. Now, when somebody says, I knew the market was going to crash and go all the way down. No. You didn't know. Neither did the big boys knew. Because the big boys piled in pretty hard. Pretty hard. Yes, they were net sellers on that day where I told people to sell the high of the day of the market on Monday, the day after the US-China meeting, the positive meeting. But I explained also the pattern symmetry dictated that we would at least get towards 28.25 and that it looked likely when you look at, this is the 1 hour chart, and if you look at the daily chart, that it looked likely we were going to go to 28.22. We got there. We got there. Now, just to recap what we talked about from the last video, I also said that we would have, this is the inverse head and shoulder pattern. We got there, and that we would come down and retest 27.45 thereabouts. We did get there, and then the breakdown happened. That's where I shorted the SPYs, intraday. So this was supposed to happen before the bond market went complete berserk, yield curve inversion, and the big forced margin sellouts. And please read that article that I'm going to post. It's pretty, it's educational to understand what inversion of the yield curve means. The inversion of this particular type of yield curve doesn't always predict for certainty that there's going to be a recession. Remember, there's an old joke. The economies, 9 out of 10 economists predict a recession after it's all over. I've seen that too. So have you guys over your lifetime. President Trump has unbelievable economic policies. He's working out through the Chinese, which I think was amazing. Okay? I don't think he's going to go into a war zone despite with the Chinese again, despite this Wawa CEO arrest. There are positive comments coming out of China. President Trump also tweeted that Chinese are being friendly, cooperative. I know he called himself tariff man, but that's primarily for political purposes. You know, talk tough on the tariff man. Markets didn't like that. No one wants to be tariff man. Remember, tariff in effect is a tool to force the other party to come to the table. That's what he did. But actually putting tariffs is nothing but a massive tax on the U.S. consumer. Obvious reasons. It raises the cost of production for all U.S. corporations. What do? Sit around there? Simple economics. They pass on the cost to the consumer. So the average Joe gets hit hard. Consumer spending starts to fall. Consumer confidence starts to fall. The U.S. economy inevitably goes into a recession. That would cause a recession. The Federal Reserve going nuts on the rate hike, which they're not, it would cause a recession. And a recession is not what we need right now. President Trump is smart enough. No, he doesn't want to throw the country into a recession and lose the next elections for the GOP and for himself. You guys understand that part? Okay, now let's go back to the charts. So here we are. So this was supposed to be the case. And then we were supposed to move from there. Well, life doesn't always take that, right? Sometimes we take a detour, a non-scenic route. And that non-scenic route was the bond route in the bond market. And that's what happened here on Monday. This was yesterday. We went below. We were supposed to come. Oh, we closed here on Monday exactly at this green dotted line, which is the Fibonacci 50% retracement level. Remember that? Right there. That's exactly where we closed at. Right there. We were holding. Then yesterday, while the markets were closed, this is where we are. We actually rallied about 16 points. Overnight didn't really matter because U.S. markets are closed today. This is last night. And this is where we are right now. So what we are doing right now is we are basically, this is a daily chart. We are breaking below this line, which everyone should remember is the break-even level for 2018. Right there. This is where we started. What a year, right? So this has been the most, I want to remind somebody, this is the most algorithmic high frequency, algo HFT dominated year ever in the history of the United States of America's financial markets, of the U.S. financial markets. This is a completely robotic, black box, algorithmic high frequency, algo HFT driven market ever. What does that mean? It means if you don't rely on charts, if you don't trade charts, you are finished. That's the reason why there is absolutely very little to no participation, why the average investor out there, mom and pop, and retail investors are dropping off like flies. You guys who are the warriors in battle, congratulations to you. Throughout all this, we have managed to make some decent money. It has been very difficult. I have put in extra work every single day to keep you guys alerted, give you ideas that have worked in the midst of this massive volatility. This is not what a market looks like under, which is driven by humans. This is 2018, guys. This is 2018. You're telling me this is not a mathematical structure? This is mathematical art, algorithmic art. That makes it extra difficult. This is an extra difficult market. That means you have to rely on the charts. The more you learn to how to messaging, reading, coming out of the charts and stuff, the better off you will do. If you think this is a walk in the park, it is not. This is a battlefield. This is the real battlefield. This is urban warfare, guys. Okay? Ask any of your buddies who are veterans, who are at active combat right now. This is fighting in the mountains of Afghanistan. I'm dead serious. Or the streets of Fallujah. Seriously. It's heavy duty stuff. Wall Street's panicking. The analysts don't know what to say. You ever seen them blabber on CNBC about what's going on? Yet we have either charted it out the day before. Not that it's easy, but we have at least charted it out. And we know the reasons why this is happening. And those guys are all blabbering. And they're high-paid so-called money managers. I'm not blaming them, but I'm just saying they have no freaking clue. And then they use the same terms that I've been using for years regarding the fact that this is a completely algo HFT black box driven computer market. All of a sudden they're just like, yo, it's all the quants, blah, blah, blah. Well, I've been talking about it for 3 years now. So this year it's really the ultimate. Okay, it's not man over machine, it's machines over man. So let's get into it, guys. So here we are. We are breaking below the magenta line, the 2018 break-even level. So at this point, we have retested yesterday, last night. Looks like we retested 2650. So if you look at it very simply, it looks like we are going to retest again the 2600 level. Just straight out. That means it'll reset big time. We have a triple bottom, which I did not ever think we would have a triple bottom this quickly. Quadruple bottom. Remember, we had 1, 2, all within a matter of this month, all since October 29. 3, and now looks like we're going to have a fourth bottom. So when you get that fourth bottom, which is around the 2600 level, which is another 400 points from here or so, okay, if we get there, we could turn midway through this cluster, which is 200 points from where we are right now. On the Dow Jones I'm talking about, not on the S&P 500. But if we get there, then you obviously want to be a buyer. You obviously want to be a buyer, short-term buyer. Because at this point, I'm going to put short and intermediate-term forecasts only because the markets are so nuts with all these different things going on, things that I explained. I can't make a long-term projection. Neither do I want to. Okay? So bottom line is, this inverted head and shoulder basically broke below the short term right now, is pretty much in the vicinity of this complex head and shoulder, believe it or not. This is your double head down here. Remember, this is what head and shoulders, a proper head and shoulder looks like. This is actually a double head and shoulder. This is what a normal head and shoulder looks like. There. You got the left shoulder, you got the right shoulder. They're not exactly always at the same level. Sometimes they're a bit slanted. You have the neckline, then you have the breakout. We already got that in the smaller head and shoulders already broke out. This is the big head and shoulder, and here's the neckline. We get towards the neckline, we get slammed down. So pretty much that's what's happening right now. This slam down is what this is. Okay? So bottom line is, let me draw this out. It just simplistically, the way things are going, you let it go. It looks like we're going to retest this 2630, 2600 level. We are at 2674. If we drop to 2630, that's about 40 points from here. 40 handles on the E-minis multiplied by 7 to convert it to the points in the Dow Jones. That's roughly about 280 points. If we fall to 2600, that's 70 points, and that would be multiplied by 7, roughly, 7 or so, then that's 490 Dow Jones Industrial Average points. So that would be where we are. Is it possible, given the technical damage that's been done in the market just in the past 48 hours? Sure. Now, does it always go down in a straight line? Nope, it doesn't. And let me show you why. Number one, you can see that here. We were crashing and burning since after we hit that 28.25 level. And I did say sell there because that's a major resistance point. You know, I've said that. And this was back on the 7th of November. Look at it carefully. Market started to sell off, looked like a fat flag, meaning like, hey, it looked like a consolidation before the market would take off. But nope, it broke the left shoulder again. Remember, this is the left shoulder, right shoulder. Broke it again. This is what it looked like. See this pattern? Focus on this. See this pattern? Very similar to this pattern. Yes, this is in one single day. It took down 800 points. Here it took 3 days. It actually took 4 days. Here in 1 day. So if you look at it, it did get down here to the 2631 level, but please look carefully. And these patterns always replicate. At this point, I do not need to prove myself because I've been showing this for years and years that this type of stuff happens. You don't need to know anything about what the reasons are, but pattern symmetry is extremely critical. Got to get your eyes and brains trained to understand this. So what happened here? It was a sharp 2-day rally. Remember that 24 to 48 hour, there's going to be a massive reflex bounce. That's exactly what happened. Is it possible that from these levels, we get a 2-day rally? That brings us up again towards this level of 27.45, which was supposed to be support, now is resistance. Can we get 2 green candles like that? Absolutely. Will it And then if this playbook plays out, you get another massive crash. Another massive crash that brings us down into the 2631 level. So what I'm saying is there is no guarantee whatsoever that this is going to be a 5-day continuation, or this is for first day, it's a red doji. Very hard to tell what's going to happen next. It could have easily gone this way, but then this happened. So now it's confirmed that we have a downtrend. So does the downtrend continue for days and days? This one lasted, and this is recent, from November 7th. 1, 2, it's called a day count. 3, 4, 5. Then you get 2 vicious days. A powerful rally. Nothing to get excited about. Time to buy down here and sell. That's what we did. And then bang, bang, from nowhere, there were 2 massive sell-offs. So if that's the case, this one lasted 1, 2, 3, 4, 5. This is 1, 2, 3, 4. And tomorrow is going to be the 5th day. Right? Tomorrow's going to be the 5th day. So we could slip and slide a little bit more. But you get that inevitable bounce to get back and retain the break-even level for 2018. That's this line here. And to go over the this big green dotted line, which is the Fibonacci 50% level, which is 2704. So if you get a 2-day rally after the first initial pullback tomorrow morning, because that's what it looks like, futures are down, actually bounced back about 11, 12 points right now. We are down 27. I'm going to show that to you on the TOS screen so you'll understand it. Now you guys want to learn a little bit more, just look at your own screens too. You got the same resources I do. Yeah, I might have faster computers and more screens, but you guys have the same resources on your platforms. So you get that rally, we scalp it. Now, is it an absolute must or mandatory that we retest and create a quadruple bottom? Since October, quadruple bottom on the full stochastics? No, it's not mandatory. We can bounce off here. After the opening, the market rallies hard. It could be a 200-300 point rally, and you know how it happens these days. It'll probably last intraday. If it gets towards those levels that I'll be showing tomorrow and on my other charts, then you want to be out. You want to be out. You got to manage your own trades. Remember, I'm not running your book. I'm showing you some very precise roadmaps that you need to follow. Okay, so that's your daily chart. You can see what's going on. Zoom out a little bit and leave this chart. There you are. Okay, big whoosh down, end of the world. Then you get this sudden move. Always the case. We drop 2,000 plus points from here to here back on February. Do you see this? You see this? And then all of a sudden, when it looked like we were going all the way down, the market went up 500 points the next day, the 6th of February, right there. Then it gave in again. Remember, this line, the dotted line, either acts as support, which is the 50% Fibonacci level, for all of 2018. This is a Fibonacci level chart for all of 2018. Okay? Right there. The low of 2018, the high of 2018. This is the high of 2018 where we overshot the 100% retracement Fibonacci, and that is right there. This is not rocket science, guys, okay? It's just simple kitty coloring book visualization with money at stake. Right there. So I drew the Fibonacci on the breakout. That was the breakout at 2880. This is your dotted green line. Keep learning, keep focusing, okay? Again, it's easy stuff. Just focus. So you got the level here at 2700, right there. It is now going to act as a resistance. It was support before. We broke below that support. We went above that support. When you blast through with a candle like this over the 50 Fibonacci, okay? The 50 Fib, then you're going to have a follow-through rally. That is exactly what happened. Massive breakout over the 50 Fibonacci. And then you had a 2-day bull flag that culminated into a exhaustion top close to the 28-27 level on the day after, as the markets opened after President Trump and President Premier had a very constructive, solid meeting on the Chinese trade tariffs. That's it. You can see that. So we demystify the markets here at Clueless 8 Trading. We break it down so you can see it in a structural view so you can be prepared. You cannot always control, but you can be prepared. When the Marines go to battle, they don't control the battle. They prepare themselves to that, so at least they know what the playbook is. Okay? They don't control the circumstances they're operating in, but they're prepared. All traders need to be prepared. I mean it. And after that, if it doesn't work, at least you were prepared. And on another note, if this type of volatility, it is intense volatility, no question about it. Don't trade. Sit back. You might miss out on some big moves, but sit back. Study the market. Learn from it without putting money into it. So that's another option you can do. But if you sit back too much, you're going to miss out on every one of these massive reflex bounces and intraday shorts that we do. Am I clear on that? I think I am. So this is where we are. Now, let me show you on the toss side. So this is your sort of the longer term picture, but I don't know what long term is because everything's happening in 24 hours, right? So this is as good as a short term chart, even though it's a daily. So we could retest 2630. This is where the normal sharp bounce normally happens. And if 2600 breaks, then that's another day story. We'll go over what the lower levels are. Because there's something else happening. This bond market yield curve inversion freaked the crap out of a bunch of quant funds. These are quantitative macro funds, which blew up, forced margin selling, and I believe that's one of the main reasons. It has to be one of the main reasons of what happened on Tuesday. Because there was nothing that negative that happened on Tuesday. Did we get into a trade war with China? No. Washington Post ran some BS fake news article that the Chinese were very displeased with what President Trump was saying. Garbage. I even put it out there. You know I'm a straight shooter. When I don't like something, I'll criticize it. And when I believe somebody else deserves respect and credit, I'll give it. That's the way I am. So I thought that was complete garbage. And the Chinese came out over the not weekend, just over the last 24 hours and said we're going to implement it. Everything went well, blah blah blah. So why aren't we up like 30 points on the futures? That's because of the technical selling that's happening because of what happened with the yield curve inversion and the massive institutional sellouts on the bond side. That is causing portfolios to sell a bunch of their stocks too to come up with those margin calls. They're using those as the source of funds or ATM to cover the margins that they have to cover. So that is what's going on. That is what caused this type of drop. Now, if you think we're going to go to recession tomorrow, well, good luck to you. Okay? All right, let's move on. So this is your daily chart. This is what we trade intraday. This is where we are. If you kindly look at it, all the lines are drawn. We have a big tail hammer reversal here at 6 p.m. today when the futures open. Doesn't really mean anything, but at this point, that is support. That is 26.53. We are at 26.74 right now. This is where the big fat support comes in, right? 26.24 on the hourly charts. And this is the second big support at 26.03. So when I post this chart, and I posted it many times on my thing, screenshot it, keep it somewhere, reconstruct this chart the same way. Investing.com is free, guys. I know some of you guys are real stingy with your money. You don't want to pay a little bit extra to have another platform like Quad to make you a heck of a lot of money, what I call penny wise, pound foolish, but at least investing.com is free, right? So you got to construct these charts. It's going to help you make a lot more money, and it's certainly going to help you lose a lot less. If you're following some other charting platform, which you have no idea how it mimics mine, you're going to be at a disadvantage. No question about it, because I am a good chartist. No question about it. I don't control the markets, but I can tell you pretty much right on, head on, what the markets will do on a good, bad, or fugly day. All right. So this is what we're going to track. There's lots of fat patterns going on. This is looking, again, this was a fantastic W pattern, which culminated here at this level. Did my job. Fantastic. It sold there. This was the big flash crash that occurred at around 12 p.m. on Tuesday. This is where we are right now. This is the downside, 2650, 2624, and 2600. Nothing happens in a straight line. And if we get a big reversal rally like this, which lasts a couple of hours, well, you got to take it. Or lasts even half an hour. You got to take it. Got to buy some of those calls. But you got to follow this chart, and then I'll put my alert. But I cannot, I warn people, put in alerts every 5 minutes, because that's not my job. And that's the reason I put out these charts, so you guys can navigate. I mean, you guys can handle your trades. All right, let's move on. This is your 5-minute chart. This is what's going on. This is for people who want to just look in real deep, right? Zooming in. This is where we are. This was the big megaphone that played out. This is where we are. Stochastics on the 5 minutes move around like monkeys on a hot tin roof or monkeys on crack right here. So don't worry about that. You get overbought, oversold real fast because it's a 15-minute chart. But you can see what's going on as we speak. This is where we are. And this candle is good for 26.70, 73, like 4 points. And this is where we are. Based on my downtrend lines, we could very well test 26.54. That's 20 points from here at the open tomorrow. And we know what the lower end is, 26.24, 26.25. Remember 26.25? Right there, right there. Okay. The last chart that I'm going to show you guys is, by the way, let me stop myself. Is everyone in sync with me? Jack, Mike, Sarm?
Yep.
Okay, very good. Jack, you're in sync with me?
I am.
Very good, sir. I know you're learning pretty fast, but I think I'm doing a pretty good job of showing you, what goes on. What you're seeing in the markets right now, and this applies to somebody who's a little bit newer to the market, has never happened in the market. I shouldn't say never. Has happened in the year of 2018, but has not happened to this degree. Why? This is all happening because of extreme automation of algo HFT programs, which dominate the landscape, which will keep on dominating the landscape. Please hold on for a second. This Thinkorswim chart, and I highly recommend everyone have an account with Thinkorswim, whether you trade in it or not, but use their charting capabilities. Absolutely brilliant. This is the start of 2018, 2nd of January, guys. Big fat rally. We've gone through this many, many times. Big fat crash. Big fat rebound, reflex rebound. Volatility intense. Exactly what we're going through right now. Exactly. If somebody says, oh, we have never seen anything like that, I say garbage. You saw more than that in these months of February to March. And you can see that very clearly. So take a quick second to look at this. Move back away from whatever screen you're looking at. I'm looking at one of my 24-inch screens. Just pull back yourself if you're looking at an iPad and just take a look at it. Just stop thinking whatever you're thinking. And just take a look at this for 5 seconds. Let's count. Good. Now your brain has registered an imprint. Your SSD, your solid state drive, known as your amygdala or your brain, has now registered this chart. So look at this. It's the same stuff. What was the resolution of this? A nice, steady, volatile rally for the next couple of months. Many months. Can that happen again? I believe that's going to happen. I believe that's going to happen. Why? Because I'm an eternal bull? Yes, I'm an eternal bull in life. Because life is the history of a bull market. Otherwise, we'd all be dead right now. No, I believe patterns replicate themselves. Every crisis, like I used to say on Wall Street to all my big shot clients, every crisis is the same for different reasons. The reaction to a crisis is either fight or flight. That's human nature. That's how our brains are wired, right? At Cluedesy Trading, we fight to win. Even if we lose that trade, we still fight. Other places, they might flight. I don't know. That's okay. We're not in the business, and I'm not here on the flight and flight thing, but I'm just explaining. So do I believe that this could happen over the following couple of months? This is the only long-term forecast I'm going to make. Yes, I think so. I think President Trump's policies, his business team's policies, this opening of doors, détente, trade ceasefire with China is excellent. It's brilliant. All this garbage, in my opinion, about yield curve inversion has to do with other factors than the Federal Reserve. Do I think the Federal Reserve is going to be moderate and even cut rates if we slow down too much? If they cut rates, oh my God, the market's going to fall like 2,000 points. Why? Because that'll show that the U.S. economy is in deep trouble. The U.S. economy is not in deep trouble. Think about it in common sense. We're cutting and working through the Chinese. We're talking about, he hasn't slapped an auto tariff on the Germans. He won't. The Germans and the Europeans are smart enough not to go through that. They'll build more plants here. BMW already has plants in other foreign companies have plants here. Toyota, they hire so many American workers. They do. So if you talk about make America great, well, they're helping do that by building plants here and hiring U.S. workers. So they'll do that more. They don't want the wrath of the tariff stuff going on and fight with the Trump administration. We're worked out with the Canadians. I hope the Democrats pass the NAFTA bill, which is brilliant. I know they're going to fight it because the Democrats, in a way, people don't realize this. I'm not making a political discussion here, but I'll tell you, the Democrats are more far against free trade than what the Trump administration has sometimes shown. Because the Democrats want massive restrictions on foreign trade. They've always been like that. So my point is, this could be next year. But see the similarity? So looking at these levels here, it's a tough call, all right? It's a tough call, meaning I can't tell you what exactly. See how fast this thing is pumping up and down right now? Look at that. Futures are down 29. So we have certain levels. That's all I'm going by. Why do I have this line here? Because this was a massive reversal on. I want you guys to focus on this. Right there, 24th of October. Look at the date, 24th of October. This was a big reversal, big fat rally, which gave in, caused those two drops, and a culmination of a serious bottom at 2,600, which sparked off the first leg of the massive rally on the 29th of October. These things happen fast, guys. You got to react fast. I'm sorry. I wish I could say, slow down the market so we can just sit back and just have a cigar and just buy and sell. No, we have to be vigilant. We have to be vigilant. That's how we make money. That's how I make money, because this is my business. If I don't do it, who's going to pay the bills? Some of you do it on the side. Do it with smaller amounts of money. This is the best learning experience you'll ever have in your life. The market and being here at Clueless Trading. That's a guarantee. That's the only thing I can guarantee you. You will be so well versed with the markets and with people taking the advanced coaching sessions. They will understand the market better than the frigging analysts and the forecasters on Wall Street. I mean that. I am an ex-Wall Street guy. I know. Your financial advisor, your broker and stuff, believe me, they don't even understand the markets. You guys know that. Let's move on. So, saying all that, this is one level, right? This was the big sharp reversal. 1 day reversal, of course. And that was, so I drew that line here, 26.52. We are right. This was the second one right there from nowhere. We were supposed to crash and burn and go all the way down. And then boom, the markets reacted. 15th of November, right there. That's 15th of November, 26.71. That's what we are holding right now and creating a Chinese firecracker type of hammer reversal. You can see that in action. And as a quick reminder to everyone, I am working on having a live trading screen, live trading chart screen, I should say, on a voiceover audio on our service for a enhanced service. It's going to cost a few bucks more, and I'm going to do that 2 or 3 days a week because I can't do it every day. That's too much. And I think some of you will just absolutely love it. You tune in, you get the live screens right there. It'll be done through this to go to meetings, so you'll have to have it open on a computer. You can dive in, you can talk, hear me on audio, not every 2 minutes, but as the markets are moving at those type of active buy sells, it'll be fantastic. It'll be fantastic. I'm working on that. Okay, it'll come soon. It'll come soon. You know, it's gonna be a few bucks more, not like $100 more, whatever. Probably like, you know, well, from your rate right now, probably gonna be about, I don't know, $20 more or something a month. And believe me, it'll be worth it. Live audio and live screens, live trading screens and live audio, live trading calls, live chart screens and live audio. I think you guys will love it. So no problem, Jack. So this is where we are. This is the next level where we had a massive turn. That's the 11th of October. We have that here. That's where we were earlier on this evening when the market dropped. This was yesterday's reversal, which was looking good. I put out that chart. Markets, you know, futures were up 11. I said, what do you think? And this is what happened. There is no way of telling what is going, so far looks like, and this is the interesting part, it is obviously very light volume in the overseas markets, in the Globex markets. But China markets will open at right now around 9 past, and then things are going to heat up again. So, but that's it. Just follow these levels. If you just want to look at numbers right there, this is your 200-day moving average right there. That is at 2673. We are way off the 200-day moving average. Remember, this was climbing up nicely, and it was still moving higher, and then this happened. So now the 5-day moving average has turned down. Short-term momentum has turned negative. Short-term momentum has turned negative. Longer-term movements like the 50 and the 150-day moving average, like I said before, still through this massive volatility, just moving sideways, just moving sideways. There is no long-term deterioration yet of the overall market, regardless of what you hear in the media. Believe the charts. This is your 200-day moving average. This is your 150-day moving average. They are still moving sideways, as you can clearly see. The 50-day moving average is plunging. The 34-day moving average, which is the orange line, where is that? Right there, is right now here. These are obviously plunging. We have with the standard deviation or the distance we travel from the 50 and the 34-day moving average is extreme at this point. It was very extreme at this level, and the market bounced up hard, went past the 34-day moving average, all went above the 50-day moving average, over the 200-day moving average. All this within the past 48 hours. Isn't it amazing? Respect algo HFT tactical moves. Enhanced volatility. Within 48 hours, we are now below the 50, below the 34, below, of course, below the 200, and below the 5. Generally, markets tend not to stay for too long below the yellow line or the 5-day moving average. Why? Because it's called resets. It gets way oversold. It gets a dead cat bounce. Either it stays above the 5-day moving average as the markets move higher, and we take full advantage of it. Look at this beautiful green candle. These are worth hundreds and hundreds of % on the SPY calls. These are hundreds of % on the downside as it stays below the yellow line on the what do you call it, SPY puts, which I tend to do it just generally intraday, because I don't know I don't want to wake up in the morning. I've gone through this a few times and it's not a good feeling where it snaps back up 400 points and I'm stuck in a bunch of puts that I can't get out of. So I do it intraday. You guys can certainly do it overnight. And this is where we are. So basically you either stay above on the reflex bounces, which can last multiple days. Remember, this is daily chart. This lasted 1, 2, 3, 4, 5, 6, 7 days. This 1, 2, 3, 4, 5, then 2 huge days, 6, 7 days of red candles. So here, this is where we are. So either it stays above the 5-day moving average, short-term momentum indicator, or below the 5-day moving average. Right now, we're below the 5-day moving average. However, there is a what do you call the 5-day moving average hasn't really crossed down in any big way. Will it cross down all the way down here? I don't know. If this keeps on bouncing higher and we cross over 2711 on the E-minis sometime tomorrow, we are going to change direction and the market will create another big bounce, which will take us to this level, which is the first level of major resistance. You can see that right there. Let's put a number here. 2750. And of course, if we take above that, that means that this sell-off was a complete fake. So boys, ladies and gentlemen, we have selectively, we have some great winners. Whether it be Tesla staying green all through the day, whether it be AutoZone, which was up a God knows 50 points almost, or 40 some points, right? On Friday, where the calls went from $19 when it was recommended. And I said they were expensive calls. Those are 840 calls for December 14th, 840 strikes. They went from $19 to $43 or $48 at one point. That's a lot. Okay? And AutoZone, which was the earnings play, went from 830 something to $880 some dollars. And this is in the middle of the market being down 800 points. You go figure. Alumina, big move higher. Then, of course, when everything fell, everything came down. There are multiple trades that worked out fantastic. But keep your trade sizes small. Stay engaged. I have guided people thoroughly through good, bad, and fugly markets. I intend to do so going forward. On that note, let's have a great week to end the week. As long as we're on the right side of the trade, we're going to do fine. Don't get over bearish. Don't get over bullish. Don't believe everything that's out there. Follow the charts and be strong. Have a great evening. Thank you.